So with stock market returns set to close heavily in the red for the first month of 2022, will there be any coming back from here? Could the market have already bottomed out with the S&P 500 seeing some resurgence at the back end of last week being up 2.5%? Or is the worst still yet to come? We're with close to $5 trillion wiped off the total value of the US stock market just in January alone. I'm certainly not counting my chickens just yet because this could be the start of something a lot more sinister. So in light of recent events and with a shaky start to the year in terms of stock market returns, during today's video I wanted to provide a little bit more of a balanced view as to what are the reasons for the stock market actually recovering from this point, but also kind of touch upon what the potential downside could look like if the worst is yet to come from here. And then at the end of the video, guys, I'll share the full extent of the demolition which has taken place over on my Trading212 investment portfolio, so be sure to stick around for that. But before I do so, guys, my name's Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video, guys. It really helps out the channel. With that being said, let's dive straight into it. So where do we start, with the good news or the bad news? Well, driven by the fact it's Monday, let's start off with the good news and actually talk about why this could potentially be the bottom of this stock market pullback or market correction or whatever you want to call it, and why stock market returns could certainly head back up to the upside from this point onwards. Because I think there's still one major thing that investors can certainly hold on to, and that's if we do still see earnings growth across the board for the broader stock market on the whole. If earnings are still coming out positive consecutively on a quarter-on-quarter basis, then it is probably one of the only things, in my opinion anyway, that could actually have a positive impact on the overall sentiment towards the stock market. And I think one of the biggest sectors in which we need to pay close attention to is actually the companies within the big tech space. Because if these companies can still continue to push on their profits quarter in, quarter out, driven by the fact that they make up about 25% of the total S&P 500 index, then their earnings for sure could still have a huge impact on the overall broader returns of the stock market. And last week was actually a pretty good week across the board for stocks, with many earnings reports coming out throughout the course of the week. First up, we had Tesla, who came out with a great set of earnings. They beat expectations across revenue and profit, with revenues up at $17.7 billion, with net income up 760% year on year. Elon Musk did cite that supply chain issues were still a huge limiting factor on the business and certainly did have an adverse effect on the overall Tesla operation. And as a result, we did see the stock tank over the course of the coming days after the earnings were released. But nonetheless, earnings were solid, which is the most important factor when evaluating a stock, as opposed to just purely looking at the price of the stock instead. Then we had Apple stock, which popped 11% after their earnings came out after another fantastic set of results. Earnings per share was up 25% year over year. Remember what I said in my last video between the correlation between an earnings per share and a company's stock price. So because of that, the earnings per share growth rate is an important number to pay attention to. Revenue was also up 11% year over year to 118 billion, showing the continuous demand for Apple products, with one analyst even comparing the big tech giant to a freight train that simply can't be stopped. Then we had Microsoft, another big tech stock that went on to beat both revenue and earnings as well, with revenue up 20% and net income up 21%. It's certainly another company that's going against the grain of expectations of investors right now. So with big tech certainly still pulling their weight in terms of overall earnings growth rates as well as revenue growth rates too, is this still something that we should be actually concerned about? Well, I guess it kind of all comes back down to the point around not focusing too much on the individual price of a stock and actually evaluating the business in which you're investing into instead. Because behind every stock price is a company that either generates value for its shareholders or not. And you certainly want to be looking at and evaluating the kind of stocks like the big tech stocks that are still being able to provide extreme amount of value to all of their shareholders. And in light of that, the movements in the stock price in more of a short-term period of time isn't something that should be paid all that much attention to. So that's certainly good news for investors, and I think if we can still continuously see largely big tech still push earnings growth rates throughout the course of the year, obviously amongst other companies within the broader stock market as well, then hopefully that will overall change the sentiment towards the stock market and hopefully allow investors to have a little bit more of a risk-on approach to their investments. So that's the good news. So now let's talk about the bad news. And I'm not going to bore you guys talking about inflation, interest rates, or the Fed reducing their balance sheet. And instead, what I'm actually going to do is show you guys a very short clip of an individual called Jeremy Grantham, who is a British investor who co-founded an investment firm that has $118 billion in assets under management. So he's an investor who certainly knows what he's talking about.
Tell me what happens. The S&P 500 peaked at almost 4,800 points. Where does it bottom?
The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the Nasdaq came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
So there you guys have it, the chief investment officer calling out that the S&P 500 during this cycle could potentially drop to 2,500 points. And that's based on all of the kind of economic fundamentals which we've spoken about on this channel over the course of the past couple of weeks. But what exactly does that mean? Well, now let's jump onto the stock chart and do a little bit more analysis. So guys, up on screen now you can see the S&P 500 chart from a monthly view. You can see right now, as of the close on Friday's daily candle, we closed at 4,431 points. So Jeremy Grantham is calling out the S&P 500 could drop as low as 2,500 points, which if I just mark out on the chart just here and continue that to 2,500 points, you can see that will actually take us back down to the lows of the stock market crash of 2020 and would fundamentally wipe out, well, pretty much all of the investment returns since September of 2017, the equivalent to 1,585 days worth of trading. In essence, just over about 4 years worth of returns being wiped off if the market crashes just like Jeremy Grantham says it will. But how much in terms of percentage terms could the market crash by if this scenario were to occur? Well, if we take the price range from the absolute market highs of the S&P 500, which peaked at about 4,800 points, and actually take that back down to 2,500 points, we're talking about a market crash somewhere in the realms of 48%, which would certainly be a hell of a lot worse than the kind of pandemic crash of 2020, which saw the market drop 35%, and is probably somewhat comparable to the dot-com bubble bursting back in the 2000s, which again saw the market drop again about 50%, and possibly even quite similar to the financial crisis of 2007-2008 as well, where the market declined about 55 or 56%. So if that is the case, we would see a deep decline in the overall valuation of the stock market along with our investment portfolios as well, probably to the point where we'll be all crying on our sofas like Ian Beale.
I've got nothing left. I've got nothing left.
So with that all in mind, guys, whether you want to believe the good news or the bad news, the truth is I don't really know the overall outcome of how all of this is going to play out. I'm simply just along for the ride. So with that said, all I'm going to do now is show you my current Trading212 investment portfolio, and I'll show you the impact on it over the course of the past month, because if I'm honest, it's been pretty brutal. So guys, up on screen now you have my current Trading212 investment portfolio valued at £23,403. You can see that I do have free funds of £595, which I will likely look to invest over the course of the coming days ahead as the market opens throughout the course of this week, depending on the overall behavior of the market, of course. Now you guys can see, if I just drop this back to a 3-month view, you can see the overall valuation of the portfolio has declined quite massively. We were up over £7,400 at the absolute peak valuation of this portfolio, where it was valued just over £28,000 with a return on investment of 35.88%. However, that was on the 4th of January, and after that point in time, it's been a red week after red week, with the overall valuation of the portfolio pretty rapidly declining, if I'm honest, losing a hell of a lot of value from it. And we actually, at the absolute worst during last week, were down just to 8.39% return on investment, seeing roughly, 27 or 28% of the total returns on this portfolio absolutely disappearing. As of right now, we do sit as a return on investment at 11.8%, with a return of just under £2,500. Now, in terms of the overall holdings within it, let me just show you guys the impact and we'll go through each one by one. So first up, we've got AMD. That's massively down over the course of the past month. It's actually one of the biggest losers in the S&P 500 in terms of the overall decline. Just in the past month, it's down 31.29%, seeing a huge amount of value taken away from that position. The same goes for Amazon, which for me now as a holding is actually in the red and is down 6.1%. Over the course of the past month, Amazon stock is down 15.67%, and to be fair, it's not performed all that well over the course of the past few months or so. In the past 3 months, it's down 16.5%. Then we've got Apple, the only stock that seems to be holding somewhat of its value over the course of the past month or so. Despite saying that though, we are still down about 5%. However, thankfully, after Q4 earnings reports came out, the stock certainly saw a little bit of resurgence last week. Then we have AstraZeneca, another stock that's been a little bit more plain sailing. If I'm honest, the likes of the FTSE 100 hasn't been as badly affected as the S&P 500 because the FTSE 100 or the FTSE 250, there are certainly more value plays within the FTSE 100, and as a result, it's not been as badly affected as the likes of the S&P 500, which is certainly deemed to be more in bubble territory. So AstraZeneca over the course of the past month is actually up 1.4%, which is probably one of the only winning positions within this investment portfolio. Then we have Meta Platforms, which again is down 2%. Another one which was very much in the green, now in the red. From a 1 month perspective, it's down 12.8%. So again, not too great in terms of tech stocks taking an absolute beating. Talking about tech stocks and high growth plays, we've then got Palantir Technologies down 46.68%. These are the next couple of stocks are the ones that have been pretty tough to swallow in terms of the overall decline. Palantir is down 31.5% in the past month. Growth stocks are taking an absolute beating, and I suspect that it won't get any easier over the course of the coming months ahead either. The same goes for Tattoo Chef, another growth play within this investment portfolio, down 43.9%. Tesla, another company that has certainly very much taken a beating over the course of the past month, down 22.29%, one of the biggest positions that's been hurt within this portfolio. It was the highest valued position within the portfolio at one point in time, and I think it's now dropped to second place just behind Apple as of right now. Then we have Unity Software, another growth play within this investment portfolio, dropped 42%, down absolutely massively. The three growth stocks which I have, Palantir, Tattoo Chef and Unity Software, are stocks that I'm simply going to hold on to over the course of the long term, like most of the other stocks within the portfolio, to be fair. And I don't have any intention of selling them, and because of that I still believe in all of the investments I've made, and I'm not going to be kind of too put off just by the fact that the price has come down, because I still fundamentally believe in the stocks and the investments in which I've made for them to actually play out over the course of the long term. Then finally, we just have the Vanguard S&P 500 ETF, which, as you all know, is down I think about 7 or 8% just in this month alone. So that's the Trading212 investment portfolio. Hopefully things take a turn for the better throughout the course of the back end of the year. So with that said, guys, be sure to let me know what's happened to your investment portfolio down in the comment section below. If you do want to learn a little bit more about navigating the current stock market conditions, then be sure to click on this video here. Be sure to drop a like on the video as well, guys, if you did enjoy it, and subscribe to the channel if you're new around here. With that being said, I'll see you over in the next video.